If the world is serious about tackling climate change, the starting point needs to be displacing all of the coal-fired power gen in the world with natural gas.
Meg O'Neill, welcome to The Business.
Thank you, good to be here.
So in your results, you say Woodside's underlying profit was affected by lower oil and gas prices. Do you expect that to be an issue going forward, especially with all that uncertain geopolitical environment and, of course, Donald Trump's tariffs?
Look, it's probably worth calibrating the prices that we saw in 2024, which were lower than 23, which was lower than 22. Go back to 2022, that was the year where Russia invaded Ukraine, caused tremendous dislocations in particularly the gas market, so we saw record high prices. What we've seen in 2024, I think, is more of a steady state and more of a normal price environment. So I think this is actually a very robust environment for us to conduct our business. So even with this, this more normalized price environment, we still delivered $3.6 billion US net profit after tax, which allows us to pay a very robust 80% dividend to our shareholders.
And analysts from places like the International Energy Agency say the next decade will be challenging for the LNG market because of increasing oversupply, which will push prices down. But I notice Woodside seems to have the opposite view, and that it's expecting a 50% increase in global demand over the next decade. So why such a big disparity?
Yeah, look, there's been a lot of discussion in the past few years around the rate at which new supply is coming into the market and the rate at which demand for LNG is growing. This is a debate that's actually played out multiple times over history. There was a comparable debate right before the last big wave of LNG investment where everyone was saying, gosh, there's too much supply, it's going to cause prices to crater. That never happened, and we believe it's not going to happen again. If you look at the projections for supply, every year those projections are updated and it shows new supply being pushed out further and further in time as permitting delays are encountered or construction delays happen. So we've actually got a lot of conviction that LNG demand growth will keep pace with, if not outpace, supply growth. And we're in the driver's seat. We've got new LNG coming online here in Australia from our Scarborough Energy project. And we're working on new LNG development in the U.S. with our Louisiana LNG opportunity. So we think we're very well positioned to take advantage of the new demand for this product.
And Meg, your company's climate plan was overwhelmingly voted down by 58% of shareholders at last year's annual general meeting, I'm sure you recall. So what changes have you made to address their concerns and to let them know they're being taken seriously?
Well, since the annual general meeting last year, we've talked to probably hundreds of shareholders. We've had hundreds of meetings to try to understand what exactly underpinned those votes, and it was a really wide range of answers. Some shareholders wanted to see more action on our Scope 1 emissions. Others wanted to see more action on investing in new energy projects. Other shareholders said, actually, we think you're an oil and gas company and you should stick to that. We issued a climate update today that talked about our progress, and our progress is delivering on the commitments we've made. We've cut our net equity Scope 1 and 2 emissions by 14% measured by the baseline. We're on track for our 2025 and 2030 net equity Scope 1 and 2 emissions targets. And importantly, we made a very significant acquisition last year in a low-carbon ammonia plant in Texas. That's a project that's underpinned by carbon capture and sequestration, which will come online in 2026. And we'll be able to offer low-carbon ammonia to the marketplace at a point in time where, if the world is serious about tackling climate change, there's going to be a price premium for this product. Now, it's also worth giving you the asterisk that this is an attractive investment even without that sort of government support. So we feel really good about the investment we've made in ammonia, and we feel really positive about the opportunity ammonia has in the future as the world looks for some of those low-carbon energy projects.
And just today, Market Forces put out a pretty strongly worded statement. They say Woodside is effectively engaging in green spin by pushing ahead of its gas expansion with what it calls no material changes to its climate strategy. So again, how do you respond to that statement, and how do you reassure shareholders who are demanding even tougher action?
If the world is serious about tackling climate change, the starting point needs to be displacing all of the coal-fired power gen in the world with natural gas. You get the same power output with half the life cycle emissions. So that needs to be step one. And that's part of why we've got such strong conviction around LNG demand growth into the future. So you've got that straight up head-to-head comparison, coal versus LNG. But the other way that LNG wins versus coal is it's far more flexible. So as nations around the world invest more in renewables and build out solar and wind, you've got an energy system that's got high volatility because of this intermittency. You need something to firm that has flexibility, can be brought online, can cover not just short periods of outages, but long periods of outages. And that's where LNG really comes into its own as the winning partner for renewables. The other thing that I'll remind your readers about, or your viewers about, is the role that gas plays in manufacturing. So a lot of the products that are manufactured here in Australia today, as well as around the world, depend on gas as a feedstock. You know, bricks, natural gas, plastics. Many of the products we need for modern life depend on natural gas as a feedstock. So that underpins our conviction around why natural gas is the product that we need, not just for today's energy system, but for the world's potentially future lower carbon energy system.
And Woodside's share price performance has been quite interesting lately. I've noticed that it's underperformed the broader share market over the past 1, 5 and even 15 years. For instance, Woodside shares down more than 20% in the past year, while the share market actually went up 7%. So how do you explain that performance to shareholders?
Look, the market's had a few questions about the capital investment program that we have ahead of us. One of the key messages we communicate to shareholders is before we make any big investment decisions, we take a look at the balance sheet and our capacity to finance. And the investment decisions that we've taken for projects like Sangomar, Scarborough, Trion, which is a development in Mexico, all of those have been underpinned by rigorous analysis that gives us confidence that we can make those investments and return value to shareholders. And if I go back to where I started, the dividend we're paying shareholders, $122 per cent for the full year, fully franked. So for an Aussie family, that works out to $2.68 Aussie, hitting their pocketbook. I think that's a phenomenal return of value to shareholders, and I think as shareholders start to see these dividend checks rolling in, they're going to realize that there's an opportunity for Woodside shares to appreciate in value.
And just finally, the federal government has delayed its decision on whether to approve your company's North West Shelf gas project until the 31st of March, which is well after the Western Australia state election. So how much of a setback is that for you?
Let me give you a bit of context on North West Shelf. So the North West Shelf project has been producing domestic gas for over 45 years. We've been exporting LNG for over 35 years. We started the application, we initially filed the application to extend the life of the project in 2018. So it took us 6 years to get the state approval. All of that same information was provided to the Commonwealth government. They initially gave us a target date of February 28th. That's now been pushed out to the end of March. But we're at the point in time where people's livelihoods are depending on this. You know, the gas that we produce in North West Shelf is critical for Western Australian customers. AMO has said there's going to be a DOM gas shortfall in WA starting as early as 2028. Well, we've got the opportunity with North West Shelf to drill some more wells, to bring more gas into the system, to try to help alleviate that gas shortage. We've got hundreds of people who work at the plants, and they and their families up in Karratha are wondering, well, gosh, what's going to happen in 2030 if we don't get this Commonwealth government approval? So I would really encourage the government to go ahead and process this approval. It's important for jobs in WA. It's important for energy prices in WA. It's important to help WA decarbonize because WA is not going to be able to shut down the coal-fired power stations without more gas in the mix. So for all of those reasons, this approval is essential.
Meg O'Neill, thank you very much for your time.
Thank you.